Well, we turned the page to November, and I hope everybody had a fantastic Halloween last night. Welcome to the Market Update Desk and Mortgage One. Today is a super busy data number day. Lots of information coming out specifically economy and jobs. So let's roll right into it. Stocks and bonds are both rallying this morning thanks to weaker than expected ADP numbers, weaker than expected manufacturing numbers, and some positive news on the Treasury front. So let's kind of get into it here. The Treasury reported this morning they're going to need 112 billion. Yeah, that's a huge number in quarterly refunding, which is about 2 billion less than what they had expected, but we're still 9 billion more than the previous quarter. So we're still growing every quarter with what we need to sell to fund the government. They also said but the positive news on this, the bulk of these bond sales are going to be short-term offerings, 2 and 5 year, and they're going to let the 7, 10, and 30-year play its course out. This is adding positive news to the bond market, and we have seen some improvement. Now, what's very interesting, this is after the Peter Druckenmiller commentary yesterday on Secretary Yellen's basically failure and costing the taxpayers about $1 trillion in bad calls from when she issued short-term treasuries back in 21 versus long-term, when we paid a lot less on that money. So coincidentally, now she is going to offer shorter terms versus longer terms. Maybe she learned her lesson, even though she's not going to have to pay for that. You and I, the taxpayer, are going to. On the employment numbers, the JOLTS report, this got us last month, but this month is a little bit better. So it came out showing job openings in September rose from 9.5 million to 9.55, slightly more. But the previous month, shockingly, there was a revision done. Government numbers and revision. That was lowered from 9.6 to 9.5 million. So when we look at the net, we're originally lower than what we were forecasted. This is giving some positive news to the bond market. Within the JOLTS report, we did see hiring rates stay about the same at 3.7%, which is still the lowest since immediately before the shutdowns in 20. The quit rate stayed basically the same at 2.3%. So that's showing really some reduced strength within the economy. The ADP report came out also today. Those numbers show that there were 113,000 jobs added during the month, weaker than expected, actually significantly weaker. We forecasted 150,000. This follows the previous month, which was unrevised at 89,000. So clearly, we are showing weakness in cooling within the jobs market. We're hoping Chairman Powell later today is going to make some commentary to the cooling jobs market. Because this is one of the main factors or things they've been trying to slow down. When we look at the 3, 6, and 12-month run rate, we're showing the 3-month job hiring rate at 127,000 a month. 6-month average, 236,000. 12-month average is 225,000. In contrast, in 22, we saw an average of 306,000 jobs created per month. This is that graph line drastically going down. Almost all of the jobs that were created were from small and medium-sized business, really the backbone of the economy. Within the services sector, there was added 107,000 jobs. So that's the big growth area within the services side. Education and health added 45,000, followed by trade, transportation, and utilities, which added 35,000. The big slowdown was in leisure and hospitality. That only added 17,000. That's been the strength of what the previous, for the last 18 months have been in the sector. They've been leading the charge. ADP also reported the annual pay for job stayers increased about 5.7% year over year. This is down from the previous month of 5.9%. Job changers saw an average of about an 8.4% increase compared to last month at 9%. Once again, we're seeing a slowdown of wage growth and new jobs created. This is specifically what the Fed is targeting, and this is positive news for what they should be talking about. Now, ADP, only keep in mind, includes private payroll, does not include government jobs. So when we see this big contrast between the BLS report and the ADP, there are specific reasons why. ADP uses a very large sample size of about 25 million payrolls, while the BLS uses a ton of imputed figures, modeling, and estimates. So for those reasons, we really feel that the ADP report really has a better technical grasp on what's going on in the jobs sector. The other big surprise and what's helping the bond market and mortgage-backed securities is the ISM manufacturing report came in at 47, significantly lower than what the market expected at 49. Employment dropped to 46.8, and the prices paid dropped to 45. Those were also in contraction areas. So this is a 12 straight month of the ISM report coming in under 50. The continued contraction in manufacturing shows that, yes, the economy is slowing, and this should filter through to the inflation data, and then hopefully filter through to the 10-year bonds and mortgage-backed securities. When we look at also new household formations, data came out today, and it showed we're on pace for 1.9 million new household formations. This is significantly less than what the new home builds are coming in at anywhere from 1.4 to 1.5 million. This is the reason why we're going to see continued growth in appreciation. We have this significant difference from demand and supply, household formations, and new builds. And as you can see, this is going to continue on this way. From the technical side of the market, we're seeing a bump on the NAS, Dow, and S&P today. And the mortgage-backed securities are rallying today. I get to say we're in the green today. It's an awesome thing. Mortgage-backed securities are at 42 basis points. 10-year bond is retreating and is down to 4.79, which is about 11 basis points down. So we are seeing some positive aspects in the market today. It's all going to hinge on what the Q&A is for Chairman Powell at the 2 o'clock meeting of the Fed when he comes out. They're going to announce a pause, obviously, in the Fed funds rate, but it's all going to hinge on what are his marks going to be? Are they going to be hawkish, dovish? Is he going to go the middle of the road? So we'll wait to see if we can continue this rally and go into tomorrow's big numbers and then the all-important BLS numbers on Friday. Give us a call with any questions, 616-293-2189. Let us put our knowledge to work for you. Have a great afternoon, everybody.